right, so thank you so much for joining us, everyone. Tonight, we're going to talk about maximizing your tax savings. We're going to do that by looking at, we talk about planning for the end of the year, but we actually do that around this time of the year. We do that between August and October. We're going to look at what that looks like. The whole goal of tonight will be for you to, since you have time before the tax year ends, to look at some options that you have for how can you change the outcome of your taxes. So I'm Jen Vale with Civitas Strategies. Margaret is my coworker who's here with me, and Magda is our wonderful interpreter. So we are going to get started now, and we will start to talk about options that you have going into the next tax year. What can we do coming towards the end of the year for our 2024 taxes? Before we get started, let's just do the disclaimer. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited, and only non-commercial uses of this work are permitted. All right, and as we get started, I would like everybody to make sure that you put your PDS number in the chat. So your name and your PDS number, so that we can make sure that you receive your certificates, that you get credit. So please continue to put those in the chat. We'll capture that and be able to get you the appropriate credit for participating. So, all right, well, as I mentioned, what are we going to talk about today? We're going to talk about where you start in a process for you to be able to affect next year's taxes, since we still have a couple, or this year's taxes next year, your 2024 taxes, since we still have a few months left in the year. What can we do in these next few months to change our outlook? If there are things that we want to change, if there are things that need to be addressed, what can we do, right? So how can we change that? Where do we start? How do we start that? We're going to talk about the information that you need to review. I will say that this particular presentation has some very lengthy numeric examples. Okay, so I'm going to be reading out some numbers, and they're all on the slide, so we can just, I'll go slow and we can just kind of follow along. It's not complicated, but when you look at the slides, you're going to see a lot of numbers and be like, hey, what the heck is she talking about? So we're going to talk about what information you need to review is going to relate to those numbers. It relates to estimated taxes. And then we have some other options in addition to estimated taxes for mitigation, right? So how can you affect your 2024 taxes before the end of the year? All right, so we know many business owners do a tax check-in, but you often don't know exactly when you should be doing that. And there is this tax check-in between August and October, which is late summer into early fall, but it's referred to as the mid-year tax review. So if you ever hear anyone talking about the mid-year tax review, we're talking about what happens now. We're talking between August and October. The effort is important, right? Because it does allow you to see where your tax liability is heading before the close of the year. So while you still have opportunities to affect your 2024 taxes. Conducting a review, it allows you to understand your tax liability, right? Because we do know that required by law, you have to pay at least 90% of your actual taxes for the current year within that year, or 100% of last year's taxes to avoid a penalty, right? And that's what estimated taxes are all about, that as business owners, we need to be making these payments to estimated tax payments to offset what our tax liability could possibly be at the end of the year, right? So the IRS does require that you be making those payments that are the equivalent of at least 90% of this year's taxes, or 100% of what last year's taxes were. So this review, this mid-year review, basically it can help you avoid a penalty, because what we're going to look at is how do you look at those estimated tax payments and know exactly where you are, and what do you need to do going forward in the next couple of months to make sure that that outcome is exactly what you want it to be, because there is nothing worse than having to pay penalties, money that you hadn't counted on paying. It would be very unfortunate, right? So we want to do everything that we can to avoid that. So what happens? How does that review? What does that look like? So what happens is that we look at all of your revenue. So far, the money you took in so far. We look at your expenses. We can compare those expenses to what you had last year, and then we try to estimate what are the next few months going to look like. And by doing that, what is our estimated profit, right? So what do we estimate? We get that number, we take a look at that, and then we say, hey, this is how much in taxes I've paid year to date with my estimated taxes. This is what taxes are looking like based on the profit that I'm estimating, and it is an estimate, right? Based on that profit, have we made large enough estimated tax payments? Or in some situations, have we been overpaying our estimated tax payments and perhaps don't need to make as large of a tax payment in the last quarter of the year? So the idea being, right, is that we're going to make sure that we don't have any difficulty with estimated taxes, but also we may have the opportunity to have some more working capital that we don't have to pay out only to get back as, a potential refund or to lower. We want to make sure that those estimated tax payments are as accurate as possible. All right. So just so you know, the process of doing this, of thinking about your estimated taxes, it basically can be as complex and in-depth as you want it to be, but it doesn't have to be anything of any great extent. But we are, like I said, we're going to look at some examples today. We're going to break it out by the numbers and what would it look like in two different scenarios. All right. So we've got to do the two activities, right? We have to look at last year's taxes. So you're going to pull out last year's taxes if you are a sole proprietor or single member LLC. You're going to pull out that Schedule C. If you are an LLC filing as an S corporation or an S corporation, you're going to look at your 1120S. So we're going to go ahead and pull that. Basically, if you happen to be a sole proprietor or a single member LLC, we're going to put some links in the chat tonight, and one of them is for what's called the Confidence and Quality Tax Rubric app. That's a great free app that those of you who are sole proprietors or single member LLCs can easily use to address some situations that could potentially occur with your taxes. But you use last year's taxes, you do an assessment of last year's taxes. So in this mid-year tax review, even if you choose to not use the app, the link that is in there, you still are going to be pulling out that Schedule C or pulling out that 1120S, right? So we have that, and we're looking at what were our total taxes last year. Okay, so we have a good idea. What are our total taxes last year? Now, we're going to then look at what's our revenue to date. So I've got that tax return. I'm going to put that over to the side. And now I'm going to go into all of my record keeping, and I'm going to look at what's my revenue so far to date. Okay, what are my expenses so far to date? Now I know what my revenue was last year. I know what my expenses were last year. I know what my profit was last year. Now I'm going to use that plus any situations that have occurred or are going to occur, I should say, that could change the outcome of your taxes this year. What kind of things could those be? We're going to look at some things that you can use to mitigate to change your tax liability. But what we need to do, right, and we're going to do it, we gather this information, we collect the revenue, we collect the expenses, and we need the most recent number for how much in estimated taxes have we paid so far. But I like you to go ahead and to look at last year versus where we are this year. And are things trending the same? Are there huge differences in revenue? Have we had a much better year this year? Did we have very large purchases this year that we didn't have last year that are going to lower our tax liability, right? Because we have more expenses that we will be deducting. So you're going to go about and gather all of the revenue that you have from any source, right? So family payments, subsidy, the CACFP program, any cash checks, anything that's paid in cash apps, we're going to grab all of that for the year, right? Which is what we do when we do our taxes anyway, but we're going to do it a little earlier this year just to see what's going to happen with our estimated taxes there. And we're going to make an educated guess. What is that going to look like for this last quarter, right? We're coming up on the last quarter. October is around the quarter. So then we're going to go to our records again, and we're going to pull all of our expenses this year to date, right? So your payroll, your rent, if you are a family home provider, you're going to pull the percentage, the time space percentage of your home expenses, right? Of your shared expenses. If you're a center, you're going to have many expenses. Where are you to date? How does it compare to last year? And what are we thinking of doing? What do we think is going to happen in this next quarter? Are we going to be making a very large purchase because perhaps we have had such increase in revenue that now we have cash on hand, our cash flow is looking good, and we have cash on hand to make a larger purchase? You're going to just start thinking about that. This is where there's a lot of estimation in what we're going to talk about tonight. So while it's not a completely 100% accurate number, and it can't be, right, because we don't know what's going to happen October, November, December, we are going to look at two methods that will give us a very good educated guess, so to speak, right? And I hate to say guess, but basically we're going to have some information based on what we've looked at and all of the research that we've been doing. So we get that revenue together, we get those expenses together year to date, and then we have to look at the estimated taxes, right? So you have to keep in mind that if you're a sole proprietor or a single member LLC, you've been making those estimated tax payments quarterly because there are no taxes being withheld otherwise, right? Now, if you are an S corporation or an LLC taxed as an S corporation, taxes have been paid for the payroll taxes and things like that have been paid. But you basically are still going to calculate, you're going to be paying taxes on the income, right, that you have after the wages, after the expenses. So, and remember, we won't go into details with S corporations, but they are taxed differently than in a single member LLC or a sole proprietor there. So we're going to look at two methods that you'll use to see, are those estimated tax payments on track? Now, I mentioned time space because time space comes into is quite important, right, for our family child care providers. One of the links that will be in the chat is to a time space calculator. So it's basically a spreadsheet. And what you do is you save a copy of that spreadsheet and you enter in the information required, and it calculates your time space percentage for you. If you're not already familiar with that, if you wanted to remeasure and perhaps put in some new numbers, and changes happen, right, in terms of the space that we use. So by all means, please save that link to the time space calculator. It can make it very easy because when we're talking about our expenses as sole proprietors or single member LLCs, we are only addressing the business use of home portion of those expenses. right? We're not using the entire expense. We're not using all of our utilities. We're not using all of our property tax. We're using the time space calculation. So we want to make sure that are adding up the correct amount of expenses, right? So we have to kind of take that into consideration. You then need to have a good understanding of what estimated taxes you've paid to date. So far this year, how much have you paid in estimated taxes? And there on the IRS website, there is a portal that you can go to see what your estimated tax payments have been for the year to date. Now, you have until the second week in October or so. Actually, in September, you were paying it's not really third quarter, but you were making your third payment for the year, estimated tax payment, in the middle of September. So that should be reflected on that in that portal on the IRS website, which is great because then we've got all the information that we need right up until this last final quarter, so that we're going to make some adjustments there. Remember, when it comes to gathering your revenue and your expenses, QuickBooks, FreshBooks, whatever bookkeeping system you use, if you are working on something, perhaps you don't have everything together, but you've been looking at profit and loss statements, there are things that you can do if you don't have a bookkeeping system, although of course we always recommend a really great bookkeeping system, and there are tools on the DECAL site that can help you with bookkeeping systems, record keeping systems. So you just want to kind of keep that in mind, that if you don't have that type of system, right, you're going to pull all the information from your bank accounts and your credit cards to get all the payment methods, everything that you've paid out, everything that you've received. It does make it easier if you have a bookkeeping system to start with. All right, so we're going to do a deep dive now into how do we think about what that estimated tax payment is going to be for this last 3.5 months, right? How am I going to do that? Because that's going to make the decision as to how much you pay in estimated taxes for this last 3.5 months of the year. So there are two different methods. One is called the profit-driven method, and one is the family income-driven method. All right, so there's two different approaches that you're going to look at. We're going to start with profit-driven, and profit-driven, it's pretty much what we've been discussing before, but you're going to see that we have, I have actual examples, so don't let numbers overwhelm you. We're gonna walk through it, okay? So we're gonna go through both of those options, both profit-driven and family income-driven. All right. So basically, what is the fastest way to look at what that last estimated tax payment should be? It's the profit-driven method. It is the fastest way to do it, but it may not be the most accurate way. The most accurate way is when you actually look at your family income if you are a sole proprietor or a single member LLC. You're still going to, want to take everything taxes into consideration if you're a center, but when we're talking about single member LLCs and sole proprietors who their profit is being carried over to their over to their what do I want to say here? Their wages are being carried over to their personal tax return, to their 1040 is what I was trying to spit out. Since that's going to go over there, that more accurate method is where we actually take family income into consideration. But let's start now with profit driven. All right. So what did we talk about? We talked about gathering all of those expenses, gathering all the revenue. What does the profit look like so far year to date? So here's an example. So in this example, Tanya had $105,000 in revenue. She had $67,000 in expenses. That meant she had $38,000 in profit. Okay. What do we want to do? Well, what we want to do is we want to see, based on that $38,000 in profit, and when I say had $105,000 in revenue, that's what she's estimating in terms of what did we do? We collected all of our revenue, we collected all of our expenses, and then we make that educated guess, what are these next 3.5 months going to look like? And that's how we're going to look at the amount of profit that we estimate is going to exist for this tax year for 2024. So again, estimation, but we're going to do the best that we can. We know how our businesses perform these last 3.5 months of the year, right? We have many years probably if we've been in business to look at trends and see how does income increase or do expenses increase at this time of the year. So again, we're going to use some education, the information that we know, and a little bit of estimation to determine what is that profit going to look like for 2024. So first goal, what is the profit going to look like for 2024? And in this instance, Tanya's estimations were that the profit would be $38,000. The next is very, very simple, okay? So I'm just going to take that profit, and as far as federal taxes are concerned, 20% is a very safe number to use for estimating your taxes. So $38,000 in profit times 20% times 0.20 is $7,600. So $7,600 based on this, this educated estimate that we're making. By the end of the year, estimated I should be paying $7,600 in taxes. I'm going to go back to that IRS website. I'm going to look at that portal. How much in taxes, estimated taxes, have I paid so far this year? What have I paid? In this example that we have here, she paid the $7,600 in taxes, okay? So basically now she's paid that, or excuse me, she's estimating by the end of the year, I'll get back in my head here, that her taxes would be $7,600. What she wants to do is take that total estimate for the year, $7,600, go back into that portal and say, how much in taxes have I paid so far year to date? Well, in this instance, the example here is Tanya went into the IRS website, and it turns out she paid $6,000 in estimated taxes year to date, right? So she hasn't made that last estimated tax payment, but so far, $6,000. She can then make a good educated estimate that her last quarter's tax payment needs to, or the last estimated tax payment needs to be $1,600. Now, let's say she had been paying significantly more every quarter than $1,600. Now, this gives her the opportunity to say, oh, look at this. I've been putting money towards my taxes that I probably didn't have to. And she may change that last tax payment. The beauty of the last tax payment that you make is that you have until the first 2 weeks in January to make that payment. So you have time to think about it. But what I'm trying to do is make sure that you have within 2024 the best use of your money. Okay, so, and that's why we do this. We want to mitigate the tax risk. We want to take a look and say, hey, what do we believe, what is that last payment going to look like? All right, so based on this, Tanya should pay another $1,600 before December 31st, which is actually due the second week in January. But we know based on her income, and it's December 31st is the end of the tax year there. So in this particular instance, right, she's going to look and see how much has, she's estimating she paid $7,600. She actually paid $6,000, $1,600. Wow, I was going to be paying $2,500, but I really only need to be paying $1,600. Or what if she has been underpaying and underestimating her profit? Well, now she knows she's going to have to set aside more money for that last tax payment to hit that approximation of $7,600, right? That we're approximating that we have to pay. So that's what you do. You take your estimated final profit for the year, that educated number, multiply it by 20%. That's the estimated tax that we believe we're going to have for the year. What if we paid to date? What does that difference look like? How does that inform that last payment that we're going to make? What does that look like? How does that, how does that go ahead and work with that there? So basically, now Tanya has a good idea of what she needed to do. All right, but before, so she can, make her adjustments as needed. But let's say based on, we're going to give you an example. All right, it's not on a slide, but I want you to stop and think about something, right? Because we want to mitigate the taxes. How do we change the taxes then for 2024? So I'm going to throw out a scenario for you that I think many of you will find to be extremely useful. All right, so Tanya has profit, right? Basically, when we looked at her estimated, she estimated that she's going to have $38,000 in profit minus the estimated taxes there. So let's say that Tanya decides, hey, I don't want to have to pay taxes on so much of my profit. What could I do to change that? Well, she can make some purchases. But something that is very, very relevant that she could do is she could open a retirement account through the business. I don't know if you've ever attended any of our retirement webinars. Basically, and Georgia does, DECAL has information on retirement posted. They have guides and such posted on the site. What she could do, she wants to lower her overall taxes for 2024. Well, what if she took $5,000 of her profit and she opened what's called a SEP IRA? That's just one type of retirement account, but she opens it through the business. All right, so she opens that. So we estimated her revenue is going to be $105,000. All right, but now her expenses, because she opened that SEP IRA and put $5,000 towards her future, that's a $5,000 expense that the business takes. All right, so those expenses go from $67,000 to $72,000. All right, so her revenue minus her expenses, $105,000. But now that she's opened that retirement account and put that $5,000, having that as an allowable business expense, plus it's going into her own retirement account. Now that she has that situation and the expenses have gone up to the $72,000, she then has $33,000 in profit, not $38,000 in profit. So what does that look like? Well, if she has $33,000 in profit times 20%, that would mean that her estimated taxes would be $6,600 estimated towards the end of the year. And she's already paid $6,000 of that. So see, by lowering the amount of profit, by mitigating your taxes, in this instance, through a retirement plan set up through the business, basically then, if she's estimated she needs to pay $6,600 and she's already paid $6,000, well, now she's going to make an estimated tax payment of $600. That's a big difference between the $1,600 that we show here on the screen. So I'm going to put on my retirement hat for a second, and I'm going to encourage everybody to think about, as business owners, setting up retirement plans through the business, taking that contribution to put towards your future or the future of your employees, and you get to take that contribution and use it as a business expense. So not only did you get to put money towards your retirement, it became a business expense. And in the scenario that we just walked through, what that allows then is for us to make a much lower estimated tax payment. That last tax payment, $1,000 difference. Boy, I would love $1,000 to put in my cash flow to have for my emergency reserve, because you don't want to overpay the estimated taxes. You want to pay the right amount of taxes, but you don't want to be having to not have use of your money, right? You always want to have use of your money there. So just by opening that retirement account, taking $5,000 of the profit as now an increased expense, right? We lower the profit, we lower our estimated taxes for the year. we've mitigated our taxes. So that is how profit-driven works. Those numbers are really simple, right? We're going to estimate our total revenue, estimate our total expenses, gives me an estimate of my profit, multiply it by 20%. That's what I estimate my taxes are going to be. Go to the IRS website. What have I paid in taxes so far? And that allows me to see what the estimated tax payment would be without having lowered my profit. But I do want everybody to think about this concept of opening retirement accounts, or if you have a retirement account through the business, just continuing to contribute. So if you have a year where the profit is going to look really great, but we know as sole proprietors and single member LLCs, we're going to pay 15.3% self-employment tax on that. In this instance, it was $38,000 in profit. We're going to pay that. And we're going to carry that number over to our personal 1040 form. So we want to lower that profit legitimately in many ways, right? And the retirement contributions are a way to do it. And it's a way that you really are taking care of yourself in the future while mitigating and lowering your tax liability. So I'll take my retirement hat off for a minute. Now let's look at the family income driven method, because this is definitely a more accurate number. So let's say Tanya says, hey, I want a more accurate number of my estimated tax bill. I don't want to just do that profit driven. I want a better idea. Well, as a sole proprietor or single member LLC, because her business taxes are included on her personal 1040, we're actually going to look at family income. So basically, we want to get a more precise number, and we can do that based on household income and deductions. All right. So what do we do there? So in addition to the information that she would have already have collected, she's going to go and find the W-2 income for her and her spouse, right? So let's say that she has a part-time job and she's being paid via W-2 at her part-time job, or her spouse has a W-2 job. We need to grab those amounts, right? So what we want to do is we need to find out how much was the total annual pay and how much withholding has been taken out of our total annual pay. So what do? You go to your last paycheck, right? So let's say you have the business, but your husband or your wife happens to have, has a job that's paid via W-2. We're going to go and we're going to grab that last pay stub, right? We're going to take that and we're going to look at year-to-date amounts. All right. What you're going to do is you're going to take the year-to-date amount, you're going to divide it by the number of months to date. So if we were doing it right now, right, we're in September, we're in the 9th month, we would basically make an estimate, take the total amount withheld, divide it by the number of months. That gives me an average of what the taxes were per month. Multiply that by 12 months, because 12 months in a year, right? And that basically allows us to see, hey, when we think about all of the whole family's picture of taxes, now we're taking those W-2 income, we're taking that into account. So let's look at this example, and it is based again on averages, but it does let you get a more accurate number, right? So we can go ahead and we can look at what our business was doing, and now we're going to look at where our spouse is at, or where we are with our part-time job, whatever it may be. So in this particular situation, we're going to say that we're doing this in June, right? And up until June, Tanya's spouse earned $54,000. All right, so 6 months. In 6 months, they earned $54,000. Well, I divide 54,000 by 6 months. That means the average is $9,000 of wages per month. All right, so now I've developed my wages per month. Then what I'm going to do is I'm going to be looking at my taxes. again, on my last paycheck, right? How much has been withheld in my taxes? In this instance, $12,000 in taxes have been withheld. Well, I'm going to divide that by 6 months. $2,000 on average is my withholding per month. All right. Again, very, pretty straightforward there. Well, I know that on average, my wages are $9,000, or my spouse's wages are $9,000 a month, 12 months, $108,000. Okay. I take that and now I go to the taxes that were withheld. I look at that average, that $2,000 of withholding a month. I multiply that by 12 months. That's $24,000, right? So we are basically saying, hey, the tax bill for my spouse's income is going to be approximately $24,000. It's based on averages, right? So what we're going to be doing is we're going to be looking at where are we with the business taxes and where are we with our family taxes, right? So family income driven. This is the way that this basically will work there. So once Tanya looked at her tax liability for the business, and then looked at what the average tax liability would be for personal, and her spouse's information that's on the paid via W-2 there, when she takes a look at this, okay, the total taxes, right? She doesn't need to actually make another estimated tax payment, all right? Because when she looked at all of her income, her spouse's income, in this instance, she had some children, all right? But basically, if we look at all of the deductions for her whole family, all the deductions for her business, when we do the estimated, it turns out that technically she would end up with $15,886 in taxes. That's going to be her tax liability for her family. All right. But so far, we're over the course of 12 months, we're going to have $24,000 in taxes when we look at the W-2 income. So that would even mean in that instance, she would not even be making a final estimated tax payment. All right. So she really didn't have to make an estimated tax payment. And that's because when such a large amount of taxes were being withheld from her spouse's paycheck, that when spouse's pay combined with the business pay, that the amount of taxes paid year to date exceeds what the tax bill is going to be. So what does that do? That $1,600 that we were making an estimated payment when we were doing the profit-driven method, that $1,600, now she wouldn't even have to make that. So when we talk about family income driven, right, we're looking at everything as a whole, because everything that you make as a business goes over to that 1040. So we're carrying over all of that. All of that profit is basically, as far as the IRS is concerned, the profit that you pay, the profit on your Schedule C, right? Line 31 of your Schedule C, that's what you pay the self-employment tax on, right? So 15.3%. But that number on line 31 is what the IRS considers to be your income as a sole proprietor or a single member LLC. And you're going to take that and you're going to combine it with your spouse's income. You know how much in estimated taxes the business has paid. Now we have a good idea of how much in taxes our spouse is going to be paying. And then we take a look and see, hey, does the business really need to make that last estimated tax payment? Am I going to be fine? Am I going to have met at least that 90% of the taxes due for that year, or 100% of the taxes the year before? So when we talk about family income driven, we really are thinking of a much larger picture, okay? And we are taking spouse income into consideration, and we're taking business income into consideration, and we're looking at taxes that have already been withheld from the spouse's pay, and we're looking at estimated taxes, and we're making a far more educated and again, I hate to use the word guess, right? But an educated estimation about what taxes are going to look like. Because remember, I want you to be able to have access through tax education. I want you to be able to have access to as much of your money as possible rather than have it tied up only to get it back next year, right? We want you to have this working capital. We want you to have this for your cash flow so that you can have this, this amazing savings account, right? So you can have an emergency account. Think of what you could do if that money was available to you. Doesn't mean you have to spend it, but maybe there is a large purchase that you wanted to make. Wow, if you had that extra money available and you spent it, you're also going to be able to take that expense as a business expense that year and really have a very nice mitigated picture of taxes. So when we talk about the family income driven, all right, basically it feels like it's very time consuming, right? Because we have to do all of those calculations in terms of figuring out the average of the wages and the average of the withholding, and we're doing all of that. But there are free online calculators that you can use, all right? And basically, if you look here, you can look for Get It Back, H&R Block, TurboTax, all have calculators there that allow you to take the business income, the family income, the amount of taxes paid, and look at what your overall tax bill is estimated to be. And then you look and see what is it that you've paid so far? And what does that difference look like, right? So we know that when Tanya looked at all of this, it's basically the total taxes that were going to be due for her family, her spouse's income, the income that she has from the business, were $15,886. But her spouse's withholding is going to allow them to have $24,000 in taxes withheld. So she wouldn't need to pay that, right? Make that that last tax payment. So she's going to be paying less than the estimated tax. She's going to have more money to work with. It allows her to save more. So there are calculators that very easily let you throw this information in, but we do have to gather the data, right? We have to get that data together. So with the family driven, we're going to get that last pay stub, right? We're going to have figured out our estimation on our schedules, what our estimation on for our business would be for our profit, for basically taking our estimated revenue and our estimated expenses. What does that profit look like? Carry that profit over to our 1040, grab our spouse's wages from that last pay stub, put it in one of those calculators, and it will tell us, based on what you've given us, by the end of the year, it is estimated that your tax bill is XYZ. And then you look at what taxes are going to be withheld, because you're not necessarily going to be adjusting the withholding for your spouse. That's going to stay the same. But now you're able to adjust that last estimated tax payment, thereby mitigating your tax liability, right? Because now we are not overpaying our taxes. We're not underpaying our taxes. We've got a much more accurate picture of what those taxes should look like. So we get all that data together. We calculate the estimated tax for our business. We calculate the taxes for our spouse's income. We take a look at that. And what do we have? What is it in our favor? Are we withholding enough taxes once that withholding happens for our spouses? Where are we at with that? What does that look like? And then that gives us the opportunity then to know what money is actually going to be left over, right? So this is what our tax bill is going to be. How do I lower my taxes? So I know what my tax bill is going to be. Now, how do I go about lowering that? All right. So when you know how much you're going to owe, what your taxes are going to be, we then want you to say, hey, how am I going to reduce my tax bill in 2024 before December 31st? And you'll see what's the first thing I have there, contribute to a retirement plan. So if you don't already have a retirement plan for your business, setting one up has these tax advantages, right? Tax deductible, and that's for retirement that you contribute for your employees as well. So contribute to a retirement plan, a higher expense, lower tax bill. We're able to take more money off of that that bottom line, right? Or so that our bottom line is lower. So we're paying less on that of that 15.3% there. Maximizing the home business deduction. All right. So what I really want people to think about is, are they utilizing business use of home the way that they should? Is their time space calculation correct? Have you remeasured recently? Because maybe there's space that now you use exclusively for your childcare business that you used to use also with your family. Well, in time space, exclusive use space is weighed heavier, it drives up the amount of our time space percentage. So it's always a good idea to kind of revisit. Things change, right? Areas that you use for your business, they change. Reinvestigate time space, and then look for all of the allowable home-based expenses that you have, all of those allowable expenses that are shared between business and home. And make sure that we're not missing anything there, right? That we have all of that. If you happen to be a center, there is the option. There are some home office costs that could be deducted. However, those rules are very, very strict. And I'm going to suggest that while, of course, we want centers to mitigate and lower their tax liability, again, they're going to look at all of the expenses for the business. You're going to think about it. Are there any purchases that they want to make to lower their tax liability? If they're choosing to look at the home office deduction, using the home for the center, using the home for the center's business, home office for the center, please speak to a tax preparer about that, because the rules are very, very strict surrounding home offices for center businesses. All right, so just keep that in mind, but it could potentially be a way that you can mitigate, lower your taxes there. What we want to do is we want to look for those other deductions. All right, so we want to look for things that maybe there was a purchase we were going to make in Q1 of 2025, but if we make it now, it's an allowable expense and it lowers our tax liability. So we have the money on hand. Let's take a look and see, can we make that purchase now? Does it make sense to make it now? Again, you may want to speak to a tax preparer and say, hey, this is my strategy. What do you think of this strategy? Should we buy the playground equipment in May, or should we buy May or March or wherever, or should we buy the playground equipment this last quarter of the year before December 31st and lower the tax liability? So I want you to stop and think strategically about expenses, about purchases you can make, whatever the circumstances may be, to lower that tax liability. I'm not saying that you should go out and buy anything that you didn't need. Certainly, if the business didn't need it, it's not an allowable business expense. But I want you to just keep in mind that there may be strategies there that can lower your tax liability there. These next things aren't about lowering your tax liability, but it's about improving your business. Pay down your debt. If you have more profit than you thought you were going to have, pay down your debt. Pay down your debt. Basically, you can paying down your debt can lower your, frees up your money, gives you more ability to pay more money to have on hand, because you've paid down your debt, have more money going into the future. Think about that. Think about how good it would feel to pay off some of the debt. Think about creating a reserve or an emergency fund. If you're going to have more profit than you thought, now's a great time for the reserve or emergency fund there. Maybe you were thinking about expansion in 2025, but if you have this extra money in 2024, hey, we still have a few months. Maybe there is an expansion, an improvement. Maybe there's something that we want to do there. Deferring income really what I want to say about that is please speak to a tax professional. So what does that mean? Well, that means, for instance, if billing was deferred until January, so if for whatever reason you don't bill families in December and you bill them instead in January, and it's kind of like a stone that rolls, is rolling downhill though, because now we've got that income in 2025. So in terms of deferring income, you have to use the strategy very carefully. Please speak to a tax preparer if anybody mentions deferring income. And then the last thing is perhaps not necessarily lowering your tax liability. That would be, but making a charitable contribution it's great for your community. It's great for your marketing. If you're making that charitable contribution within the tax year, you are going to, if it is an allowable expense, allowable deduction, yes, you can lower your taxes that way. But also just keep in mind charitable contributions, all the other things that it brings to the table. So if you are contributing to a charity that is tax deductible, yeah, that's going to lower your tax liability. But also keep in mind that there are many, many benefits. So this is what we do. These types of strategies are what we do if we have more profit than what we expected. What do we do if we have less profit? What if our revenue is low, or maybe we have no profit? What are we going to do for these next few months, right? We still have 3 months. Well, let's review and reduce expenses, review all of the business expenses. Let's make sure that we're improving our billing and our collection processes. This I'm very cautious about, exploring financial options, like financing options, I should say. Again, please consult with a financial professional about that. We don't want to see you increase your debt there. Your pricing strategy, when have you revisited your pricing lately? Things of that nature. And again, when you find yourself in a position where you have lower profit than you expected, or perhaps a loss, it's time for professional guidance. All right. So if you are finding yourself, after you've done all your estimations, to have lower profit than what you expected, these are some strategies that you can use. All right. So in conclusion, what are we doing, right? Proactive planning for that year-end time. It's a crucial process. You're doing this at exactly the right time. You analyze your revenue, you analyze your expenses, you look at your estimated tax payments. You look then at what is that profit going to look like? What is my tax obligation going to look like? We do that. So we've analyzed, we've estimated, then we've decided, are there any options that we have to lower our tax liability, mitigate our taxes, and then we work with professionals to make sure that we are making the best decisions for our business's particular circumstances. But we've done all this work and we have a much better picture than we did prior to having this conversation on there. So after today, what I am hoping is that you now understand all of the documentation that you're going to need. Here we say submit your annual return because that's all the same documentation that you're going to be using when you file your taxes. But I want you to have all of that so that we can do the estimation on this year's taxes, where we can look at costs, we can look at savings, right? That's what we're going to do. And then what options do we have for lowering that tax liability? I want to keep that in mind. So that's what I'm hoping out of everything that we're doing.